All right, guys, what's up? So we're going to be start talking about week 3, part 2, which is strategic planning. And essentially, just to start off with, we have the evaluation of FP&A opportunities. So there's basically a lot of roles within financial planning analysis that have like the title analyst. Like you have financial analyst, business analyst. You also have like research analyst and stuff like that. And then within those roles, you have like scenario planning and forecasting roles. So it's like looking ahead and trying to figure out what the situation is and trying to forecast finances. And they're becoming even more popular to uncover market trends or firm performance in different market scenarios. And then even within strategic planning, you have both quantitative and qualitative measures. And then they're both like large enterprise divisions in firms, and they both like try to accomplish the same goals, but in a clearly defined manner. And then you also have, use data. We also use a lot of data visualization tools that just essentially allow the firm to look at their goals, to see how they've progressed, and then also like looking at stuff throughout various projects just to like, track performance. And then some popular data analysis tools and visualization tools are SQL, Tableau, and Excel, and also Python. And then having these, having knowledge within these fields, it's really attractive and it's really good for the job market. Sean, do you have anything that you want to add to this slide?
On my end, I don't think so. I think generally this is a pretty good overview of what FP&A looks for. I think you need both quantitative and qualitative. That's the most important part for me. A lot of people, when they think FP&A, they think ratios and NPV analysis and stuff like that. And that's certainly important. That's a core function. But you also need to know how to, connect that to qualitative decision making. Because if you don't do that, then what's the point of numbers? That's just data. That's just data. You have to turn it into meaningful information.
Also organization structure plays a really big role when you're throughout FP&A. So it can either be centralized or decentralized or a mix of the two. So for example, centralized would really be from like a top-down perspective where you have a managerial team and they're essentially making all the decisions for everyone else. Whereas for decentralized, it can be more involved where like lower level divisions may make like some managerial decisions, or they may make some decisions that have like a lot more impact. So for the first level hierarchy, they can either be by geographical region of a firm operation. So that would be decentralized. For example, it could be like an office in New York City or office in San Francisco. Or you could even have it for the firm's product or services, and that would be more a centralized approach. So for example, like Apple for like their iPhone, that would, or like whatever, that would be like a product, right? And then for hybrid, which is kind of a mix of the two, it involves product FP&A workers collaborating within a project hierarchy, and then they're reporting their findings to the leader of each product group. So it's like going back to like Apple, right? That project, like those specific like analysts within that product from Apple would be reporting to those leaders. And then that also kind of goes in the same with like the region, the hybrid model as well. And then oftentimes teams will also revolve around technological competencies of the team members. So for example, you have like a data team or you have like a Tableau team, an SQL team, or even just an Excel oriented team where they'd be like monitoring within those specific functions and trying to make it work. So there's also a bunch of different directions within FP&A. So we can start off with like the data and financial analysis. So this would primarily involve Excel, SQL, or Python, or other tools for direct data analysis. Then you'd also have the financial and goal reporting. So this would use visualization tools to create reporting structures for the organization. And then they'd also create scorecards, trends, or percentage of goal reach, or like they'd use those metrics to like try to evaluate how they've reached their goals and what else they can do. And then you have forecasting and modeling. So this is basically just using data visualization or just analysis tools to look for the future and try to model those trends and patterns that a company might have. And then scenario planning. So using the tools that we previously mentioned to like plan a financial situation under different scenarios. Like if it's a good scenario or a bad scenario, they're trying to use that to plan ahead for the future.
I think another thing I didn't mention, but it's also a part of scenario analysis, is sensitivity analysis. So scenario planning is where you manipulate multiple variables in order to create different scenarios. And that's more multivariable, changing. Whereas sensitivity analysis is a type of scenario analysis where you only manipulate one variable, and that variable lets you see how sensitive your projections or your model is when you change one variable. So using that, you can determine which variables are most sensitive and which ones are least sensitive. Now, this could be like a % change in cost of goods sold, or what happens if you raise the price 10%? What happens if you lower production or raise production by 5%, right? Just using all of those metrics, we can determine which of those line items are the most important when it comes to manipulation. Are we in a highly or lowly elastic industry? High elasticity essentially means that consumers are very sensitive to price change. So you don't want to change your price too much in those markets. Otherwise, they'll just go to a competitor, whereas low elasticity means you can change the price a little bit and you'll still have the same amount of demand. So you can change the price there. That's where sensitivity analysis comes in. And it's kind of like a subset of scenario analysis where you only change one variable. It's also very important in FP&A. Even Treasury and controllership, they do it a lot with variance analysis too.
So this is just an example of data visualization, right? So we have the graphs up here, and then basically this would be looking at the productivity rate of different businesses and just examining, if you can look down here, right, they have the different percentages, and then for here it's 74%, so it goes up to here. Or you have the net earnings, looking at what the revenue is, and then you can basically use this to track how the performance is, and then also presenting it to different people. And you kind of have like a line graph here. So this is basically an example of how you would visualize data when you're presenting it, or even just looking at it to like make it appear in a more easy to understand manner. So this would be one of the financial analysis tools that's often used, and it's called Collective by Microsoft, right? So if you want to look at this report, it's actually really easy to use. Sorry, one second. Right, so it's like really interactive. You can play around with like the different years you want to look at. You can look at the specific quarters that you're trying to look at the data from. You can even play around with the months within those quarters, right? So if I want to just look at Q1, then I could look at January specifically. Or if I so let's just go to 2016 and then all of them. Oh. Sorry, 1 second. So this would be presenting data for all of 2016. So we can examine the revenue here, the expenses, the assets. So we can even look at what the goals are that they've like measured and how close they got to it. And then this would be essentially a comparison. So we can play around with the total revenues and expenses and see how total revenues, which is the line on top, is grown compared to total expenses. And we can see towards the end that total revenues is higher than total expenses. And then we can also examine total liabilities versus assets, total assets. And this also is like another really cool data visualization tool. We can check this year's versus last year's. So LY, right, the orange would be looking at last year's for the selected amount, whereas the top line, the black one, would be for this year's. And then we can even examine like the top expenses that we spent. So for example, we spent most of our money in salary expense, paying salaries and wages. And then they even have like other things. So for example, this one would be rolling accounts receivable versus rolling accounts payable balance. So over here we can examine that as we like gradually get through it, like accounts receivable actually kind of stagnates, whereas accounts payable increases. So we have more accounts payable than accounts receivable. And then this will also break down the balance sheet, right? So for this basically cash is predominantly like the most amount of on the balance sheet here. Then we have a small portion of inventory. And then even get cooler, like we can also check. Oh, sorry.
Yeah, no, you're definitely on the right track. I just want to say real quick, this dashboard alone, and we'll get into this a little bit later, and if you're a finance major, which I'm sure you all are, you'll kind of learn a lot about this slide and what we're trying to accomplish here in your treasury management course. So why we're looking at inventory and accounts receivable, accounts payable is essentially we want to see how well we're doing at getting paid every year, how many times we're completing our cash conversion cycle, which is essentially optimizing our days receivable turnover, or days receivable outstanding, days payable outstanding, and days inventory outstanding. Basically, we want to get paid from our customers as soon as possible. So our days receivable outstanding, we basically want to minimize that. We want to minimize our days inventory outstanding. So whenever we purchase something from our suppliers, we want to get it out of our inventory as soon as possible. We want it finished and we want it out, so that we can put it down as cost of goods sold and it's not just sitting there in inventory, potentially getting spoiled or something like that. So we're trying to minimize days inventory outstanding, or DIO. And finally, we're trying to maximize our DPO, which is our days payable outstanding. Now, what that means is we want to take as much time as possible to pay without messing up our supplier relationships. And that essentially means our suppliers give us a good or a service, and we don't pay them now. We pay them in terms of our net credit terms. We could pay them, if it's 210 net 30, which is we have to pay within 30 days, or by 30 days, I should say. We want to pay as close to that 30 days as possible, unless taking the discount is financially beneficial to us. That way we can get that service or good, and we don't have to give up any cash right away. This is great for cash flow, and it's great for kind of finishing that cash conversion cycle. So you want to reduce the amount of receivables you have at any given point in time. You want to reduce the amount of inventory you have lying around at any given point in time. And you want to increase at a sustainable level, in a mature and practical level, increase the payables so that you can, extract value out of things while not having to pay in the short term. And that's why we're kind of gathering all of this stuff together and comparing their rolling balances overall, which ones are high, which ones are low, what the balance sheet looks like, because we have to maintain the balance sheet. We can't just keep producing stuff in order to reduce their variable costs. We also have to make sure that we don't keep producing stuff and our inventory goes way up, because that's bad for the balance sheet. That's a lot of money that's down the drain because we spent so much on building up inventory for goods that we will have never sold. So, finance is always this balance between profitability and liquidity. You always want to know how much you need to produce in terms of your goods and when to stop, so that you're not producing too much to the point where you have to get rid of stuff from inventory, or your inventory is lying around for a long period of time, especially if it can spoil quickly, like food, for example. You want to maintain that balance. That was my 2 cents.
Yeah, so this final part is a profit and loss statement. And Sean, if you want to add anything to this one too.
Yeah, profit and loss. So this is mainly taking into account the income statement. This is basically the income statement. The last one was mainly balance sheet stuff. AP and AR are current assets and current liabilities, so they would also fall in here. But in terms of the income statement, yeah, I mean, they show a year-on-year kind of amount for each of those line items. And we went over each of these last week, revenues, COGS, the gross margin, which is revenue minus COGS, those fixed expenses, or SG&A, that's the overhead that you need to pay your employees, rent, machinery, other equipment, other expenses, taxes in there as well. And then from operating margin, from that you get the operating margin. Then you get rid of amortization, depreciation, which is how much value is lost in your assets over time. You can kind of amortize that. And then, of course, taxes at the very end, which gives you your net income. And it's really well visualized in this Power BI dashboard because it's showing you a year-over-year change. Sometimes numbers don't really matter as much as the change percentage does. Over here, we can see that our sales went up 7%. So did our cost of goods sold by 69%, right? So even though sales went up, the cost of incurring those sales went up way more than that. I believe that's what it says. Yeah. So last year it went from like 147K to now it's 250K. Gross margin did, however, increase. So yeah, there's a lot of stuff that we can take a look here. Why did some things go down? Why did some things go up? How can we increase profitability if that happened to go down? That's it from my
Yeah.
end. Go ahead.
I was gonna say that even on the side, we can like look at the expenses and see how total revenue is growing to total expenses, and then also like specifically like breaking down the expenses that we've had and the revenues, and just looking at which one accounts for the most amount of it and which one accounts for the least amount of it, so we can learn how to like kind of figure out what we need to do next.
I think that's pretty much it for this presentation. Like I said, today's was extremely short. We just basically wanted to wrap up strategic planning and show you an example of what a dashboard showing the cash flow, mainly income statement and balance sheet statements, all visualized in an analytical manner. And for all my BITS people, so people who are in business, IT, society, or have heard of it, in the BITS channel, there is a Power BI kind of workshop that we did. I don't think we used financial data, but there are a lot of kind of tutorials out there on LinkedIn Learning or even on the BITS channel and on many other types of, many other platforms that'll show you how to make these P&L statements on Power BI and how to basically automate your processes when it comes to analyzing your balance sheet, your P&L statement, your cash flow statement. And at the end of the day, these numbers, they look great. They look very suave and whatnot. But at the end of the day, most important thing is what conclusions can we take out? What questions can we ask the business that has these P&Ls, that has a balance sheet change last year to this year? Why did accounts receivable go up? Why did payables go up? Why are they losing money on a year-over-year basis despite having a strong balance sheet? That kind of thing. So that's it from my end. I think we can conclude, unless Risha, you have any comments?
No, I don't think I have any.
Okay, I'm gonna conclude the recording.